I'm Tyler Suiters in the Energy News Center, and with me now is Elliott, our regular energy commodities market analyst, who is with the Energy Letter and the Energy Strategist. Elliott, good to have you with us once again today.
Thanks for having me.
Major announcement yesterday about offshore exploration from the Obama administration. No bump in the markets, of course, yet. What do you expect to see, either in terms of supply or in terms of price changes going forward?
I really don't think it's going to have much of a near-term impact. Even if the drilling started tomorrow, it would take many years to actually, go out and prove out some of these plays and start actual production. So I don't think you're going to see any near-term impact on supply. I think it was mainly a move because it's a very popular move. People are unhappy about higher energy prices, particularly higher oil and gasoline prices, and this is seen as a way of addressing that, at least psychologically.
T-Boone Pickens weighed in almost immediately after that announcement, saying we're not going to see any of this supply for 10 years. But still, there was very little, if any, reaction from the oil markets itself. Really, the weak, at the time, U.S. dollar was pushing prices up more than any other factor. That still seems to be number one right now.
Yeah, although we've seen a little bit of a shift in the oil market this year. Generally, since about mid-December, the dollar's been strengthening against the euro. In particular, mainly as a result of the problems going on in Greece and some of the other sort of peripheral countries in Europe. And despite that fact, oil has been pretty strong. Oil today is sort of breaking out above its range, breaking out to the sort of $84, $85 area, very important technical resistance level, despite the fact that the dollar is, while weaker yesterday, is generally much stronger over the last few months. I do think that reflects a view that the supply and demand fundamentals are actually tightening up as well.
The latest natural gas inventory report is out just this morning. Overall, inventories are up marginally, but two key numbers that I locked in on here, Elliott. 1% lower than we were 1 year ago, and yet almost 11% higher than we were on the 5-year average. Which one is more significant in your mind?
I think the 5-year average would typically be seen as more significant. Last year was a very unusual year, mainly because we were still seeing the lingering effects of the sort of Great Recession, as it's come to be called, really a drop-off in industrial demand for natural gas, coupled with very, very strong production from these shale plays. So that's going to kind of distort the year-over-year figures. Looking at the 5-year average, though, we are above average. We did see a lower than expected build. And I think one of the issues that was going on there, why we're seeing a little bit of an uptick in natural gas prices, is that some people had been expecting sort of the whisper number as to how much the build would be, was a little higher as a result of last week being higher than expected, and the ongoing view that we're seeing very, very strong production from these natural gas shale plays.
And we're seeing an almost immediate bump in natural gas prices as a result of that.
Absolutely, because you're seeing sort of the expectation, even though the consensus number was about a 19 billion cubic foot build, we got 12. I think that the sort of whispered number had been more like 25 to 30. Some people had been expecting that we'd see a build of that level because of some of the pipeline data we've been seeing and some of the data we've been seeing about production from the major producers in places like the Haynesville Shale being very, very strong production. So I think the whisper number was even a little higher than the consensus estimate, and that's why you're seeing a little bit of a bump. The other thing that I think we're seeing is natural gas finding a key support level, somewhere in that sort of $3.75 to $4 range. It doesn't seem to want to drop below that. I think if you get too far below that, you come to a level where even the most economic shale plays in the United States start to become very questionable. And so I think we'll probably see that level hold.
Okay. What about oil now? This week's EIA report, along with the numbers, also showed that 4 U.S. refineries were either idled or shut down. Is that making a difference in your mind, or is it a significant number that are idled or shut down for this time of year?
It's certainly it's not unusual to see refiners idle. Refineries when margins are low, which they're still pretty low, even though they've ticked up a little bit since late last year. The other thing I think you're seeing is a lot of refiners sort of rationalizing their exposure. We've heard from a number that have actually not just idled refineries, but are actually shutting down operations. Valero's done that. We've heard from both Exxon and Chevron that they're looking at rationalizing their U.S. refining portfolio. So I think that's really another trend to watch, is not only refineries that are actually being idled temporarily, but refineries that are being just closed or sold off.
Elliott, final question. Looking forward to next week. The latest Bloomberg survey says it expects inventory will be up, demand will be down, and in turn prices will fall a little bit. But we go back to that supply and demand factor, and that has not necessarily been keying oil prices lately.
Right, and I think also the other thing to look at is that one of the things we're seeing is that though the U.S. oil market is pretty glutted in the sense that there's plenty of oil in storage, there's plenty of gasoline in storage. Demand overseas has been very, very strong. And I think within 2 years, we'll probably see global oil demand exceed its 2008 peak. And it's not going to be the US, and it's not going to be Europe, it's not going to be Japan. None of the developed countries are going to be driving that. It's going to be places like China and India. And we do tend to look at, as oil market traders, we do tend to look at those EIA reports very, very carefully. But the reality is they are becoming generally less important. If I go back to sort of 20 years ago, your OECD countries, your developed world countries, 65% of global oil demand. Now it's more like 50%, and 20 years from now it's going to be probably around 40% or even a little bit less. So the impact of the US market is less and less on the global oil market. And I think that's one of the reasons that you're seeing this disconnect between US fundamentals and global prices.
Elliott is the editor of the Energy Letter and the Energy Strategist as well, our regular analyst on markets and commodities. Elliott, good to have you with us.
Thanks for having me.
And thank you as well for joining us. I'm Tyler Suiters, and you're watching Plain Skies News.